have been detained during protests. And we're live at HSBC's Global Investment Summit in Hong Kong, where we'll speak to Greenmantle founder Niall Ferguson and the bank's Hong Kong head of wealth and personal banking. Plenty coming up on this hour. It's just gone past 8 a.m. across the Emirates, 5 a.m., 6 a.m. actually here in South Africa. I'm Jennifer Zapasaja. Thanks so much for joining us from Johannesburg. It is a busy day and has been quite a busy week just starting off, and especially if you take a look at the focus now for markets really being front and center again on tariffs. We had a little bit of waning tariff news last week, but now Monday really supercharged the rhetoric back into the fold. So really what we got on Monday, we mentioned this briefly, but President Trump potentially suggesting that he will have more focused tariffs, or in fact, he potentially could exempt some countries from tariffs. And the markets really applauding that news and saying that potentially if we do see a little bit more targeted tariffs, potentially that could be good for equities. And we did see on Monday all the major U.S. indices closing in the green right now. S&P futures pulling back ever so slightly. Asian equities also giving up some of those tariff-led gains. But we did see the U.S. indices having one of their best days for 2025 so far on Monday. We'll see whether or not that continues throughout the session once it begins later today. But those tariff comments also helping to support risk sentiment, sending yields, though, on the 10-year to the top of their recent range, climbing about 9 basis points. If you take a look at the 10-year yield, relatively steady right now at 4.33% there. But we also got comments from the Fed's Raphael Bostic saying that he's actually dialing back his expectations for rate cuts to just 1 this year, that weighing on treasuries as well. But the 10-year, as we mentioned, at about 4.33%. Brent crude still being really fueled, the price action, by geopolitics and, of course, tariffs. And, of course, that also coming as Trump mentioning secondary tariffs on those who import Venezuelan oil. And so Brent crude right now holding above $73 a barrel. And our MLive team, though, suggests that traders continue in the long term to turn bearish on the price of oil due to many of the comments that we've talked about over the past few weeks, the fundamentals just not being there to support the price. And finally, gold still strengthening a little bit after Trump's latest tariff threats. Uncertainty still feeding into the markets about what this all looks like as we head into April 2nd. Still gold holding about $3,015.17 there an ounce. And we've seen bullion rally 15% this year on increased haven demand. And for your terminal chart this morning, I'm going to keep bringing you this because tariffs really are the focus here. The sweetener we teased in the open is in reference to what Trump is suggesting, that he may give some countries breaks on tariffs. And yet betting markets still see a lower chance that Trump will impose larger tariffs, but still a higher than 50% odds, as this chart is showing you right there. Now, let's just stay on our top story. President Trump says he will announce tariffs on vehicle imports in the coming days, while indicating that some countries will receive breaks from next week's reciprocal tariffs. For more, let's bring in Bloomberg's John Harney. John, quite a bit of conflicting news as it comes to tariffs and what we heard from the White House on Monday. Give us a sense, bring us up to speed on what we should know.
Well, as our Josh Wingrove reported, this is yet another announcement on tariffs and has sowed yet more confusion about what's actually going to unfold, who might be spared, who might actually have to pay the penalties. These were automobile tariffs, automobile imports that he was talking about today. And this is these may be announced before his sweeping tariff regime is to be presented next week on April 2nd. So it's still unclear what's going to happen. There are loopholes. There are ways various countries can perhaps get out of being hit with tariffs. So everybody's still waiting at this point.
So what's next then, John? I mean, what could we potentially hear on Tuesday? Would we get any clarification from the president, or are there other officials that we could potentially watch out for?
Well, the head of the European Union trade for the European Union is going to meet with Howard Lutnick, the Commerce Secretary, and Jameson Greer, the U.S. Trade Representative. But some people are getting ahead of even that. Some companies are getting ahead of the curve here. Hyundai, the South Korean auto giant, announced that it was going to build a plant in Louisiana, a red state, of course. And President Trump announced this at the White House with Governor Jeff Landry of Louisiana, a fellow Republican. And he was obviously very pleased with this.
All right, we'll leave it there. Bloomberg's John Harney. Thanks so much, John, for joining us. Joining us now to dig into a little bit more of the market reaction is Ryan Lemand, CEO and co-founder at Neovision Wealth Management. Ryan, we were just talking to our reporter about some of the latest news on the tariff front. Are you getting any more clarity about what this could potentially look like leading into April 2nd? Where do you stand on this current tariff talk?
Well, it's confusion. It's a total uncertainty. So no, I don't have any answers because every day brings something new. We were at large scale. Now we're more focused, and the markets, unfortunately, are moving at the tune of this. So we have zero uncertainty at the stage, and add to it overvaluation. Price to sales above 5. PE sometimes 200, driving the market with NVIDIA, for example. Yes, we are in total uncertainty, unfortunately.
Ryan, though, we did mention we saw equities, at least in the U.S. on Monday, rising to their best day in 2025. Could that momentum keep up?
This will pretty much depend on what is the next move regarding tariffs. If tariffs turn out not to be so focused and more large scale, then probably not. We don't expect U.S. equities to continue at this upward path that happened last night following the good news from more focused tariffs. However, if they turn out to be more focused, then yes, obviously, we will go back to rallying. However, I'm not sure they will be so focused because let's look at President Trump's aim. It's to generate revenue, to lower taxes. And the U.S. imports $3.3 trillion of imports. So even if President Trump's imposes 50% tariffs, this is just a small fraction of tax receipts. So tariffs will have to be higher to have an impact on the U.S. economy. So not sure how they can be focused, but at the same time, lower taxes.
Where does that place you, Ryan, and where you want to invest right now? Do you step away from the U.S. at this point until there's more clarity, or where do you focus?
Because there is overvaluation in U.S. equities, we're very close to the year 2000 tops. We have rotated away from the U.S. to a large extent, and that was a few months ago in preparation for what's happening today. And we've gone into Chinese equities, we've gone into European equities, we've gone into Indian equities, and we've done extremely well there. Also, 25% of our portfolio has been gold. We've done very well there as well. We've booked some profits at $3,000. And we're waiting for the pullback to go back in. So the advice to investors is diversification, geographic diversification, and staying away from what is very overvalued, because this will be the most volatile risk assets.
Where do you see the pullback, though? What is the pullback for? What's the catalyst for the pullback for gold, Ryan?
The pullback for gold is a detente on the geopolitical front, potentially a resolution of the Ukraine issue, potentially a meeting between President Trump and the Chinese authorities. So any detente of any kind on a geopolitical trade perspective could cause a pullback in gold. However, as of today, all of the elements that have caused gold prices to go up are still there, among which BRICS central bank countries buying gold.
Ryan, you mentioned that we're close in terms of valuations to the 2000 levels that we saw. Does that mean that you potentially think we're headed towards a potential bubble, and this could soon be even more detrimental if you continue to be overweight in the U.S.?
Oh, we believe we are in a bubble in the United States equities, and particularly in the tech sector. So this bubble can last a long time. I'm not saying it can burst anytime soon. And the catalyst for this burst is basically China. And we've seen it as soon as DeepSeek was announced at a very awkward timing. If there's more news on the tech side from China, creating cheaper AI, cheaper chips, etc., this could be the catalyst to lower U.S. equities, specifically the tech sector, to more reasonable valuations. But until this happens, this whole party can continue for a long time.
Have you decided yet what sectors in Europe, Ryan, you would invest in at this point? Because Europe is sort of, stuck in the middle of a few different stories and headlines right now.
Well, the most obvious sector is defense, with all of the European announcements with regards to spending on their defense budgets. That's not a sector we like very much for many, many reasons, but it is the most obvious sector. And anything related to the defense sector will be dragged up because clearly Europe will be spending quite large sums of money on defense, given what's happening on the Eastern Front.
All right. We'll leave it there with you. Ryan Lemand, always great to get your insights. CEO and co-founder at Neovision Wealth Management. Thanks so much, Ryan. Now, also, Hyundai has announced plans to invest almost $6 billion in American manufacturing, including a new steel plant in Louisiana. The company also says it will spend about $21 billion in the U.S. through 2028 to increase vehicle production, confirming earlier reporting by Bloomberg. President Trump hailed Hyundai's plan, saying it's a clear sign that tariffs work. Boeing reportedly wants to withdraw from a deal with U.S. prosecutors to plead guilty to misleading regulators before the two deadly crashes of its 737 MAX aircraft. The Wall Street Journal says the plane maker is seeking potential leniency from the Trump administration, which is reviewing many pending white-collar criminal cases. And now, coming up, over 1,000 people have been arrested in Turkish protests as President Erdogan takes steps to stabilize the markets. More on the fallout following the arrest of his biggest rival next. This is Bloomberg. Morning, Onur. This is Jennifer in Joburg. How are you?
Good morning, Jennifer. I'm very good. How are you doing?
Good. Are you still in Dubai or?
No, I'm currently in Istanbul. I'm
in
that transitional phase.
Still I see. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Turkish President Recep Tayyip Erdogan is pledging his commitment to the investor-friendly economy policies he embraced back in 2023. Erdogan is blaming the opposition for market volatility spurred by the detention and subsequent arrest of his biggest rival, Istanbul's mayor, Ekrem İmamoğlu. Meanwhile, Turkey's Interior Ministry says more than 1,100 people have been detained during protests across the nation. For more, let's bring in Bloomberg's Onur Ant from Istanbul. So, Onur, these are some striking words from the president, considering some of the events that we've seen over the past few days. Talk to us about how he plans to ease investor concern that was really dented last week.
That's true, Jennifer. Both Erdogan and the rest of his administration, including Finance Minister Mehmet Şimşek, have been in a concerted effort to deliver one key unified message to investors, which is that yes, there is political turmoil in Turkey right now, as you said, triggered by the detention and the subsequent arrest of a major, formidable Erdogan rival. But this is not going to result in Turkey abandoning its investor-friendly conventional economic policies that have been in place since 2023. We have seen Turkish authorities intervene in markets and announce various measures, including those that are meant to support the lira since the turmoil began last Wednesday. But I think today we are seeing sort of a new peak in those efforts by Turkish authorities to ease concerns amid investors. And that's down to the fact that both Erdogan came out and made his pledge last night after the cabinet meeting, and also down to the fact that Mehmet Şimşek will hold his first call with international investors today at about 1 p.m. London time.
Even so, Onar, we are hearing from S&P Global saying that there is a risk to more instability in Turkey's economy given given the unrest. What is the expectation then for the markets moving forward?
Well, the markets have already been rattled, and quite significantly so. We are seeing that the lira is down by more than 3% since the events began last week. Turkish stocks and Turkish government debt posted some of the world's biggest declines compared to their peers. Having said that, we are seeing some signs of stabilization, albeit at a different level in Turkish assets, including the lira itself. It was little change just before this show began. At about 7 a.m. Turkey time, it was trading at 38 per dollar, which is still 3% lower than where it was last week. But still, there are signs of stability. And we would expect the signs of stability to start from the lira and then later sort of feed through the rest of Turkish assets, if that is going to be the case. Now, it's too early to say the turmoil, the rout has come to an end, but surely there are signs that things may be stabilizing after last week's basically massive drops in Turkish assets across the board.
Onar, what do we know about İmamoğlu? He is now detained, as we were mentioning. What is the likely path ahead for him, his political future?
Well, his political future has been dealt some very serious, if not fatal, blows last week. İmamoğlu, right before his detention, his university diploma was revoked by Turkish authorities on various allegations of wrongdoing, basically. And that's a key pre-requirement for anyone to run for presidential office in Turkey. Not only that, now he is behind bars. He was detained last Wednesday, and later he was formally arrested. This means that he's going to be in jail pending trial until when prosecutors need to produce an indictment. So we're looking at a potentially very lengthy legal process during which he needs to prove he's innocent, and also he needs to overturn the decision to revoke his diploma. Unless he can do both, he will not be able to compete in a presidential election against Erdogan or whoever Erdogan's successor might turn out to be in elections currently scheduled for 2028.
Yeah, it's a great update there. And just correction, İmamoğlu is jailed. Just want to make that correction there. Bloomberg's managing editor for the Middle East and North Africa, Onar, thanks so much for the update. Great to have you on. Now, Samsung Electronics has announced that its co-CEO, Han Jung-hee, has died at the age of 63. The company says Han suffered a heart attack. The 3-decade Samsung veteran oversaw the consumer electronics and mobile devices division for Korea's largest company. He's widely credited for building the company into an industry leader for TVs, displacing Japanese rivals. And coming up, The Atlantic's top editor says he was added to a text group detailing plans to bomb Houthi targets in Yemen. The details on that next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. The Atlantic's top editor says he was added to a text group where U.S. Defense Secretary Pete Hegseth shared detailed plans for bombing Houthi militants. Jeffrey Goldberg says he received a connection request via the encrypted messaging service Signal from National Security Advisor Michael Waltz. A White House spokesman says the report appears to be authentic, and they're reviewing how the journalist was added to the conversation.
I've heard I was characterized. Nobody was texting war plans, and that's all I have to say about that.
Bloomberg's executive editor for the Middle East, North Africa, and Russia, Stuart Livingston Wallace, is joining us now. So, Stuart, not exactly a headline the administration particularly wants. Talk to us about the details and really the significance of this, if true.
Yeah, morning, Jen. So, yes, I mean, again, if it is confirmed, and the indications, at least from the White House, are that it appears to be genuine, I mean, it does two big things. Number one, it really calls into question just what is the security apparatus in place, because it is, I would say, incredibly unusual for this group to be communicating with each other about these actions on basically a third-party app. And Signal is secure, but nonetheless it is not, I would say, the typical platform they would be using for these kind of communications. So I think it does raise some questions about the security there. But I think more importantly, look at the content and look at the comments that particularly came from the Vice President about sort of their general view of maritime trade, who's providing security, you know, why isn't Europe stepping up to the plate? All of that, I think, plays into this idea about the US going forward and its commitment to preserving maritime trade routes around the world. Now, remember, these are hugely important. It is something like 90% of global trade by volume, not by value, travels by sea, and therefore these maritime trade routes are hugely important to the global economy. Now, in fairness, this change of attitude from the US that had basically lasted more or less 80 years, that started before the second Trump administration, so it is not a new thing, but it shows this sort of ongoing change of attitude towards the US's willingness to basically guarantee global trade and let everyone else take advantage of that.
What does it mean, Stuart, for the situation in the Red Sea and in Yemen more particularly?
So, I mean, it's basically been the stepped up attacks on the Houthis. So that followed the breakdown of the Gaza truce. The Houthis then came out and then said they were going to be targeting Israeli ships once again. That obviously has this much wider impact because no one really wants to travel up the Red Sea through the Suez Canal. So that has this sort of huge knock-on effect again on global trade. So the US went in very aggressively. It is said that it's going to continue this over certainly several days, several weeks, you know, and we'll see just quite what that looks like. But other actors have been involved in this too, so that we know the UK, amongst others, has been involved in attacks on the Houthis to try and degrade them and try and protect that maritime trade route. And again, you've seen the Europeans grouped together to basically provide convoy services to ships there. Nonetheless, that trade, particularly the container trade, has really fallen off a cliff, and those ships are all now taking that longer route around southern Africa. And that has a huge impact on shipping costs, which in turn has an impact on the speed of trade, which in turn has an impact on inflation, which in turn has an impact on monetary policy around the world.
All right. Stuart Livingston-Wallace, really appreciate you joining us. Bloomberg's executive editor for Middle East, North Africa, and Russia, joining us there from Dubai on the latest. Thanks so much, Stuart. Let's just take a look at where your markets are positioned ahead of the trading day. We mentioned on Monday was quite a strong day, at least for U.S. equities, after we did potentially get some indications that tariffs would be a little bit more targeted. Clearly, that hasn't been fed through to futures right now. We're seeing downside for both U.S. equities and also Euro Stock 50 futures. The question, though, is who is going to be targeted on these looming tariffs that are supposed to come on April 2nd, and what will be the ramifications for a lot of companies and countries more globally. All right, coming up, we are live at the HSBC Global Investment Summit, where we'll be speaking to Greenmantle's Niall Ferguson. That's next. This is Bloomberg. This is Horizons Middle East and Africa. Our top stories this morning. President Trump signals auto tariffs are days away, while hinting at sweeteners in next week's reciprocal trade plan. Turkey's president pledges his commitment to investor-friendly economic policies. Meanwhile, the nation's interior ministry says more than 1,100 people have been detained during protests. And we're live at HSBC's Global Investment Summit in Hong Kong, where we'll speak to Greenmantle founder Niall Ferguson and the bank's Hong Kong head of wealth and personal banking. That is all coming up in the next half hour. It has just gone past 8:30 a.m. across the Emirates, 6:30 a.m. here in South Africa. I'm Jennifer Zabasaja in Johannesburg. Plenty of news from the HSBC conference this morning, and we'll bring you this latest bit of information. HSBC CEO Georges Alhedri says he expects to double down on investment banking operations in Asia and the Middle East after exiting key businesses in Europe and the U.S. We spoke exclusively to him at the bank's Global Investment Summit in Hong Kong.
What we announced is we will be incurring about $1.8 billion of cost, essentially severance cost.
Okay.
That the saving, most of the decisioning for that will take place this year. Most of it will take place in the first half of the year. That the benefits will start materializing this year, where the $300 million benefit will come this year. That the benefits will materialize in full by the end of full year 2026. So the full year 2027 will benefit from the full $1.5 billion saves that we're targeting. What we also committed that these will be permanent saves going forward, and that we're taking these saves straight to the bottom line. So it's a payback period of effectively roughly 2 years, but it's a permanent benefit that we will achieve.
And then the other component there is a further $1.5 billion, which I was looking at your earnings statement, and it was page 11 or 12, I think, of the strategic review. And the way you phrase it there is a reallocation of those costs into growth businesses. So I think it's a two-part question I have is, if you're reallocating costs, is that a net savings? Is $1.5 billion net savings? And what exactly are you looking at doing? Because there's not a lot of detail on that.
Yeah. So the organizational simplification benefits, which are efficiency saves, not impacting revenue in any material shape, $1.5 billion, those will be taken to the bottom line. That's the first $1.5 billion.
Yes.
Now, additionally to that, we're also looking at what we do and recognize that there are further focus that we can achieve in our business, where we will be taking $1.5 billion from activities that we are currently doing that are either non-strategic or non-returning, and we will reallocate these $1.5 billion as we materialize the saves. We reallocate them back into areas where we have competitive strength, where our customers expect us and need us to be, where we can generate good returns, and where we have greatest opportunities to grow. This second $1.5 billion, the revenue we will lose against it because we will be stopping activities.
Those units, those assets, yeah.
Those assets. We expect to be able to generate better quality revenue instead, because they're more strategic or higher returning.
And have you told your team, have you given a timeline for that second tranche of?
Yeah, we expect to do it in the medium term, but there are a number of these initiatives which we already communicated to the market. For instance, about $300 million of this $1.5 billion will be delivered through our decisions around investment banking, in particular M&A and ECM, in Europe and in Americas, where we're basically scaling down this activity. And others will come from other inorganic activities, such as the sale of our German private bank business, the sale of our French insurance business.
The timing of perhaps, and I know it's under review, so I'm not sure how much detail you could give at this point in time, but you mentioned a lot of those decisions will be made over the next few months. And correct me if I'm wrong, I think the timeline you gave was you want to complete the review by June of this year. When do you think you'll be able to make meaningful announcements?
So with regards the efficiency saves, most of the announcements are done. The rest is execution. We will be able to talk to how much we've decisioned. But again, we have committed to achieve these saves by the end of full year 2026. So we're working on that timeline.
Right.
With regard to the reallocation of costs from non-strategic or low-returning areas to strategic, areas of stronger competitive advantages and higher growth prospects, and obviously higher return prospects, we will announce as and when we have something to announce. So as I said, I've shared with you some of the ones that we've gone public with, and then the rest, as and when we're ready to announce, we will make it public.
What's the message to employees, though, who I'm sure you understand and can empathize with? There's a level of uncertainty out there over job security. What is the message to employees? Well,
the first message to employees is a big thank you, because the momentum that we've been driving with this business and the results we've generated, as was communicated in February for our full year 2024, is the focus, the relentless focus of our employees and their focus on supporting our customers. And obviously a major thank you to our customers because of the trust that they placed in us to give us their business. And it's very important that we carry on this mission. Primary mission is to serve our customers. Customers are at the heart of everything we do, and then serving our customers remain a primary, unwavering objective for all our employees, whether you serve them directly or whether you serve other employees who are in turn serving those customers.
Is talent retention an issue at this point as you go through this painful but necessary process?
Yeah, so it's inevitable that when you go through similar organization simplifications, there are some roles, mostly at the senior level, where you have duplication and where at the end of the day you will lose some roles or some individuals due to the duplication of positions, mostly again at the senior level. So that is an inevitable outcome from such an exercise. But in general, we're a bank that highly values talent. We're a high performance culture. We want to attract talent, we want to retain talent, we want to train talent, we want to give opportunities to talent, and we want to be able to reward them competitively.
And you know, a lot of the focus, I've covered your bank for many, many years, and you have a very, very strong franchise here in Hong Kong. In fact, it was strong enough that you decided to make it a standalone component and business line. And I'm wondering, are any assets in Hong Kong under review in terms of the wealth business or any of the assets here, or suffice to say, are these assets safe or what's the best way to describe it? I'll let you say it instead of me speculating.
First, I'm very proud to say that we're celebrating this year 160 years of HSBC, and as you know, we were born in Hong Kong. We were born in March 1865 in Hong Kong, about 200 meters from here. And then a month later, we had the first office in Shanghai, and then within a year, we had offices around the planet. And that's 160 years ago, and you know, big parts of this region, you know, didn't exist the way we know it today back 160 years, and we've served our customers all the way through this journey for the last 160 years. Hong Kong is the heart of, you know, is one of our two home markets, Hong Kong and the UK, heart of HSBC. We have customers that we've served for decades, if not for 160 years. We keep investing in Hong Kong. It's a major growth area for us. Hong Kong is on track. Well, Hong Kong is a global financial center, but is also on track to become the largest cross-border wealth hub in the world sometime this decade. And we're a major beneficiary of this trend, and we're here to serve our customers in Hong Kong.
I mean, suffice to say then you're happy with your footprint, or if not looking to increase your footprint here?
Absolutely happy with our footprint.
What about investment banking in Asia Pacific?
Absolutely happy with our investment banking in Asia Pacific. Look, for the investment bank, we obviously want to double down on all our capability around debt. That's debt capital markets, leverage acquisition finance, and other financing activities, because that's the heart of everything we do globally. And in regards Asia and the Middle East, we want to also double down our capabilities in M&A and ECM. So the exit that we're processing now in Europe and the Americas is to allow us to focus at the areas where we can really be differentiating to our customers, where we play to our competitive strength, and where we really bring value to the markets, to the economies, and to our customers.
HSBC CEO Georges Al-Hedari speaking exclusively with Bloomberg's David Inglis, the first time he has spoken on TV as a group CEO. Great conversation there. Let's stick with HSBC's Global Investment Summit in Hong Kong and turn now to Bloomberg's Rebecca Chung-Wilkins, who is also there and joining us now with a guest. Rebecca?
Yes, thanks, Jennifer. So we are here with Niall Ferguson, author, historian, and the founder and MD of macroeconomic and geopolitical advisory firm Greenmantle. Let's talk geopolitics. It's the sort of backdrop for the whole summit that we're speaking here. And of course, US-China is really central to that. What do you think it is that the Trump administration is getting wrong about China and Beijing's policy?
Well, I think it's important to have consistency, and right now there is no consistency in US policy on China, because there are members of the administration, on the NSC, the State Department, the Defense Department, who are very hawkish, and then there's the president himself, who is very dovish. And it's not clear who's really calling the shots here. If you judge them by their actions, this is a hawkish administration on tariffs, on tech restrictions, on national security issues. But if you just listen to President Trump, he wants to do a big, beautiful deal with Xi Jinping and go to Beijing, or have him come to Washington. So which is it? I'm not clear.
To some extent, this also speaks to, in fact, what some sort of call the war for President Trump's mind here. When it comes to foreign policy, there are very different, contradictory fundamentally different views among his advisors, not just on China, but on the role that the US should play in the world. How do we make sense of that? How are you making sense of that when it comes to US-China policy?
I think there are kind of three camps. By the way, it's not unusual for a president to have different factions within an administration. That's kind of normal. So there's let's put them this way. The maximalist hawks think that the US confronts an axis of authoritarians, China, Russia, Iran, North Korea, and it has to take them on everywhere, in Eastern Europe, in the Middle East, and in the Far East. Then there's a kind of middle group of kind of hawkish who say, we can't do all of this, but we really do need to focus on the Far East. Taiwan is the big issue. This is Bridge Colby, for example. And then there are people like Stephen Miller, who's basically arguing, and J.D. Vance, the vice president, hey, we don't care about the rest of the world. We just care about the Western Hemisphere, and as long as China leaves that alone, we're good. It's not clear to me which of those three groups really has the upper hand, nor is it clear to me exactly where Donald Trump himself stands. So there's a very interesting period at the moment of formation. It's kind of an emerging properties story where we're seeing these different views kind of interplay with one another, and we'll only really know, I think, by the end of the year what the dominant strategy of the administration will be.
Okay. There's one big question mark, too, over precisely how US-Russia relations play out. There's been much discussion about so-called reverse Kissinger. I know you're dubious of that. But we also have ceasefire talks between Russia and the US in Saudi Arabia this week. If the US and Russia are able to find an agreement, there is a ceasefire, and US lifts sanctions, do you see a recalibration of the relations between China and Russia? And what does that look like?
I've heard reverse Kissinger, I've heard reverse Nixon. All of this alludes back to the events of the early 1970s, particularly 71, 72, when Richard Nixon stunned the world by saying he was going to go to Beijing and meet with Mao Zedong. The idea of a reverse Nixon is that the Trump administration is going to be so nice to Vladimir Putin over Ukraine that somehow they will peel Putin away from his partnership, his friendship without limits with Xi Jinping, the Chinese leader. Now, there's one problem with this theory, namely that Nixon didn't peel Mao away from Brezhnev. China and the Soviet Union were at war in 1969, and all the United States had to do was take advantage of that split and accept a Chinese invitation to establish some kind of negotiation. This is a very different situation today, and the other point I would make is that to give President Trump his due, he's achieved something that Richard Nixon wanted to achieve. He's made America's allies realize they have to do more for their own national security and stop riding on America's coattails. That shock has finally woken European leaders up to the realization that Ukraine is their problem and it's not going to be America's problem for much longer. So I don't want to be entirely negative. I think there have been some major achievements in that respect. The problem is, are you really going to end the war in Ukraine as quickly as President Trump led people to think he could? And having just listened to Steve Witkoff's interview with Tucker Carlson, I have to say this is not the obvious way to bring about peace in Eastern Europe by giving the Russians pretty much whatever they want. I don't think it peels Putin away from China, and I don't think it ends the war in Ukraine on a good basis.
I mean, to that point about the US potentially offering Russia a favorable outcome to them as they perceive it, if that does happen, do you think that changes Beijing's calculation on Taiwan and particularly the US willingness to defend Taiwan?
Well, there is a linkage. There are connections. It was Biden's failure to execute the withdrawal from Afghanistan successfully that encouraged Putin to think that he could take Ukraine without too much of a fight. If the fate of Ukraine is to be that of South Vietnam, a country that the United States supports until it doesn't support it, which then vanishes from the map, then I think China will conclude that it's dealing with a fundamentally weak United States that is unlikely to put up much of a fight if it makes a move against Taiwan. If, however, Ukraine emerges, as South Korea did from the Korean War, as territorially reduced but still strong enough to be an economic success story, I think that's a very different outcome. And it's not clear how it ends for Ukraine. Taiwan's the bigger issue, though. You're right to ask that question. And as I said, an ambiguous American policy makes it very hard to predict exactly where things go.
It's also the reason, Neil, I think that you're going to be very busy here over the next the next couple of days. That's Niall Ferguson. Thank you so much for joining us. Excellent to have you, founder and MD of Greenmantle, joining us live at the HSBC Summit. Jennifer, back to you.
Good. Good stuff there, Rebecca. Great to get you and your guest on. Thanks to Rebecca Chung-Wilkins for that conversation. Now, coming up, U.S.-South African relations continue to sour after Ambassador Rasool is expelled from Washington. We'll speak to Democratic Alliance MP Emma Powell next. This is Bloomberg. South African Ambassador Ebrahim Rasool has returned home to a swarm of supporters after he was expelled from the U.S. Rasool says he has no regrets about the comments that led to him being told to leave Washington. The ambassador had stated that Trump and his supporters are a supremacist movement projecting white victimhood. The U.S. State Department calls the ambassador's remarks unacceptable.
This was the equation of the president and the country with white supremacy. And these remarks were unacceptable to the United States, not just to the president, but to every American. They were pretty much obscene when it came to the nature of what was alleged.
Joining us now is Emma Powell, South African MP for the Democratic Alliance. Emma, great to get you on. Let's just start here. You recently returned from Washington as well. How would you assess the U.S.-South African relationship right now? Describe it for us.
Morning. Thanks for having me. Well, we have seen ever since the executive order was issued by President Donald Trump that there's been a significant deterioration in regards to the formerly very strong and cordial bilateral relation. There have been a number of allegations made against South Africa by President Donald Trump's administration in regards to the expropriation of land without compensation, race-based laws targeting Afrikaner minorities, some of our Black economic empowerment laws discriminating against those same minorities, and then nuclear collusion with Iran allegations in regards to this. We've seen a deterioration of relations that has, I think, hardened attitudes on both sides of the aisle. Then we've, of course, seen carve-outs in terms of PEPFAR, the president's emergency package on AIDS relief, and other various forms of aid that has been provided to South Africa for many years that funds things like anti-illicit wildlife trafficking operations. We've also seen the United States withdraw from the just energy transition. So the attitudes on both sides of the aisles are indeed hardening, but we are working towards finding a pathway towards de-escalation and stabilization.
Did you meet with any senior officials in Washington, and what did they tell you?
Yes, so the presidency in South Africa is delaying putting together a formal coalition government delegation. The Democratic Alliance, in light of the urgency around the situation, decided that myself and Andrew Whitfield would travel to Washington. We met with Marco Rubio, the Secretary of State's senior political counselor. We met with the National Security Council advisors on Africa. We met with the chairpersons of the House Foreign Affairs and Africa subcommittee, as well as ranking Democrat and Republican senators on those same committees. We were trying to find out from decision makers at both Congress and the White House what would be required from South Africa in terms of various foreign policy concessions that they would consider to be suitable in terms of de-escalating these increasing tensions. And we also, at the same time, wanted to provide factual, accurate information in regards to expropriation without compensation and race-based legislation.
So then what comes next? Has there been discussion around who will be the next ambassador in these discussions, and not just in the White House, but also within the government of national unity?
So I think this is the important point, is that we now have a coalition at the national government level in South Africa. The former Liberation Party that governed South Africa for 30 years, the African National Congress, received 39% of the vote. They no longer have a monopoly on foreign policy. So we as the DA have called, we released communications last week saying that we are calling on the presidency to initiate a formal foreign policy realignment and rehaul discussion at the national executive level, the cabinet level, and that we are requesting, whilst the constitution in South Africa is indeed clear that it is the president's prerogative, our founding statement of intent that codifies how the coalition will work states that there needs to be sufficient consensus in regards to any policy-related decisions. So we are asking that the DA, as the second largest stakeholder, now has a voice in terms of making sure that the appropriate appointments are made instead of politically connected cadres, as has been the case for 30 years.
So that means no one has been named at this point in time.
No one has been named. I know that there are a number of names that are doing the rounds. That is bound to happen. We believe that the situation is indeed urgent. A new ambassador who is appropriately qualified and skilled must be appointed as soon as possible. Our trade with the United States is incredibly critical.
Really quickly, should we still expect President Zelensky to visit South Africa? Could that have an effect on relations between the U.S. And South Africa?
Well, my understanding is President Zelensky is supposed to arrive on the 10th of April. To my understanding, that visit is still going ahead. Of course, that visit was planned prior to some of the, you could say, one could consider confusing messaging coming out of the United States in regards to their position on U.S.-Russia relations. South Africa has positioned itself as a mediator to the crisis, and to my understanding, that visit will still go ahead. Yes.
All right, in just a few weeks' time. Emma Powell, we have to leave it there. South African MP for the Democratic Alliance. Appreciate you joining us from Cape Town. Thanks so much. Now, let's stick in the region. Ethiopia has reached a deal with its official creditors to restructure $8.4 billion of international debt, which will slash debt service by $2.5 billion through 2028. The move is a key milestone in the nation's efforts to overhaul its loans and boost growth. For more, Bloomberg's Ndiro Aganga is joining us now. Ndiro, walk us through how this restructuring plays into Ethiopia's ongoing efforts to overhaul its debt and also boost growth.
Hi, John. So we can look at this in two parts. In terms of growth and sustainability, it's going to, first of all, it will unlock FX reserves, and this is going to boost the country's reserves after it struggled with severe dollar shortages. It's also going to unlock money that can go into crucial sectors like agriculture, healthcare, education, but most importantly, release them from debt distress. And we need to remember that barely 6 years ago, Ethiopia was one of the fastest rising economies in Africa, but then again, drought happened, COVID-19, a civil war for 2 years, and this really affected the economic growth. Now, if we look at the second part of this, the restructuring part, there's something to be said about the fact that this is just the first step. The real legwork lies in getting bondholders to agree to a restructuring deal after Ethiopia defaulted on its $1 billion Eurobond. And you have this ad hoc committee saying that the IMF is really underestimating Ethiopia's improved macroeconomic conditions, and that if you look at last year, economy grew by 8.1% as opposed to the projected 6.1%. Ethiopia has secured an IMF deal. They've already gotten 1.5 billion of that. And so this is a country that does not necessarily have a solvency issue. It's a liquidity problem. And they have rejected IMF's request for debt relief. And they've even threatened to sue so that Ethiopia can pay them the full amount. And we're seeing this push and pull because if you look at Africa's debt portfolio, it has changed. Initially, it was just OECD countries. Now, China is one of the largest bilateral lenders to the continent. Then you have a sizable chunk of private bondholders. And so getting everybody on the table to agree to a restructuring deal that suits all their needs becomes very difficult.
Fantastic reporting. Bloomberg's Ndiro Aganga in Kigali for us. Ndiro, thanks so much for joining us. Now, coming up in the next hour, UOB's Heng Koon joins the show with his market outlook, and we're heading back to HSBC's Global Investment Summit in Hong Kong. Stick with us. This is Bloomberg.
This is Horizon's Middle East and Africa, our top stories this morning. President Trump signals auto tariffs are days away, while hinting at sweeteners in next week's reciprocal trade plan. Turkey's president pledges his commitment to investor-friendly economic policies. Meanwhile, the nation's Interior Ministry says more than 1,100 people have been detained during protests. And we are live at HSBC's Global Investment Summit in Hong Kong, where we'll speak to the bank's Hong Kong Head of Wealth and Personal Banking, Maggie Ng. Good morning. It has just gone 5 a.m. here in London. I'm Tom McKenzie. Welcome to the second hour of Horizons Middle East and Africa. Let's check in on the markets then after a solid day on Wall Street with the gains coming through for the Mag 7. The likes of Tesla ending up around 12%. You saw Mag 7 stocks up about 3%. You saw the Nasdaq gaining more than 2% and the S&P ending the day up more than 1.8%. Today across the benchmark in Asia, the MSCI Asia Pacific is down 0.2%. We have the mixed messages again on the tariff story, and we'll break that down for you in the next couple of minutes. European futures pointing low by 0.3% after a bit of softness across European stocks yesterday, falling by the end of the close in Europe by about 0.1%. S&P futures after the gains of yesterday pointing low by 0.2%, and the US 10-year currently yielding 4.32. Not much movement, but yields were up 9 basis points yesterday. We had the Fed's Raphael Bostic, telling Bloomberg he sees now just one cut through the rest of this year, and partly on the uncertainty around the Trump tariff plan. Let's flip the board and have a look at the terminal that describes and illustrates the uncertainty around how markets and investors are betting on the size, the scale and the implementation of these Trump tariffs. The betting odds then from Polymarket, as you can see, the expectation that Trump imposes large tariffs, that expectation has dipped somewhat. We've been having these mixed messages. April the 2nd is the day. There has been as well some language from Trump suggesting that there will be exemptions for some nations. Auto tariffs, he says, will be coming in days. Pharmaceutical tariffs at some point soon. So the mixed messages certainly, and the reporting over the weekend, that possibly the extent and scale of these tariffs will not be as large as some had feared, that they would be more targeted. Those are the betting odds, and that is how markets, or at least some investors, some putting money to work in the betting markets, are starting to adjust their views as we lead up to April the 2nd next week. Let's check in on how the Asian markets are faring. Avril Hong, standing by in our Hong Kong studio. Avril.
Yeah, Tom, I mean, it's really about those tariff uncertainties, right? And as the clock ticks down to April 2nd, given how we've seen the messaging about potentially a narrower scope for U.S. levies, that's what lifted the Asian stocks in the early goings. But you're pretty much looking at potentially another day of declines on the region's benchmark. And the drag has been not just about the tariff uncertainty as the session progresses, but also coming from Chinese tech names. You're looking at potentially dipping into correction territory on the Hang Seng Tech. And as I say, it's about tariffs, and that clock ticking towards April 2nd also seems to make investors a lot more sensitive to some of these corporate developments. We had Alibaba's Zhou Tai, for example, saying that, this bubble seems to be emerging when it comes to the build out of AI data centers. And then Xiaomi confirming its upside share buyback. That seemed as potentially putting some pressure on the stock. Of course, one of the most expensive in Chinese tech names this year because of the dilution effect. So that's what we're seeing for now in stocks. And of course, when it comes to the currency, under pressure, some of it the tariffs, some of it to do with the dollar-yuan fix that's been nudging higher. But also investors are digesting the PBOC's MLF tweak, which comes against the backdrop of the central bank trying to transition to the 7-day reverse repo as the main monetary policy mechanism. Tom.
Over Hong in Hong Kong. Thank you very much indeed with the check on the Asian markets. A little bit of softness right now across the benchmark. Some redhead crossing the terminal right now. This is on European car sales, falling 3.1% in the month of February. The total number coming in at 963,540. But importantly, this is the biggest decline in 5 months, as concerns, of course, about the economy in Europe is holding consumers back. One standout was Spain, interestingly, where the the number of new additions in terms of autos actually increased. They saw a rise in sales in Spain, including a 61% jump in electric vehicle registrations. But the top line is coming through from the Automobile Association of Europe. European car sales falling 3.1% in the month of February. So watch the automakers at the open in Europe, 8 a.m. UK time. Now, to what is happening in terms of the policy front from the Trump administration. The president says he will announce tariffs on vehicle imports in the coming days, while indicating that some countries will receive breaks from next week's reciprocal tariffs. For more, let's bring in Bloomberg's John Harney, who is across the details for us. John, what is the latest that we've been hearing from President Trump in terms of how he's thinking about prioritising tariffs?
Something Scott Bessent, his Treasury Secretary, struck me as very intriguing. Bessent says that tariffs, according to, in the Trump administration's strategic vision, involve a negotiating tactic, or can be used as a negotiating tactic for revenue and for equalizing trade. In other words, to get rid of trade deficits. I think you're seeing quite a bit of that strategy at work here in Donald Trump's latest announcements, which only seem to heighten the confusion and perhaps anxiety among companies, allies, etc. Because, as you point out, there are many ifs. Some countries may be spared, some may not. And it's really unclear what he's going to do before with these auto tariffs, say, and then on April 2nd, when his great tariff regime will be apparently presented.
John, specifically on the question of autos, because, of course, we had that 30-day exemption, or at least that carve-out pushing back some of those auto tariffs focused on Mexico and Canada, key parts, of course, of the North American supply chain when it comes to the auto market. How able are the automakers of the US, the GMs, the Fords, others, how able are they to kind of adjust supply chains in that kind of time frame? I mean, essentially, given what Trump has been saying about auto tariffs coming in the days ahead, how concerned should executives at those auto companies be right now?
Well, they are concerned, of course. And again, there's a great deal of uncertainty here. Now, one company, Hyundai, has perhaps gotten ahead of the curve. Today, Monday, at the White House, the company announced it was building a major steel plant in Louisiana, a red state, Republican state. And Donald Trump was obviously very pleased with this announcement. And, this means that there won't, perhaps that South Korea will not have to worry quite as much about tariffs. And Hyundai won't either.
OK, we'll see if that Hyundai decision around investment in the US pays off, not just for that company, but South Korea as well, as we head up to the decision, of course, from the Trump administration on April the 2nd. John Harney with the details and the analysis, given what we've been hearing from the Trump administration, the president himself as well, in the last 24 hours or so. John, thank you. Let's get more of a market take right now. Heng Koon, Executive Director and Head of Market Strategy at United Overseas Bank, joins us for the market take on this. Heng, how do things stand in terms of the way that you model the potential tariff impact, given what we've heard, the reporting over the weekend that maybe this is going to be more targeted, the comments from Trump himself that maybe there'll be exemptions for some countries? Do you start to downplay or at least de-risk the tariff scenario when you think about your investment decisions in the short to medium term?
Good morning. So when I speak to a lot of the corporate managers, as you say, there's a little bit of, if I can use the word candidly, complacency in terms of what to expect on the 2nd of April, that this is all just negotiation, and that President Trump will scale back a little bit of his tariff threats. But for those of us, when we look at the objective numbers from Asia, right, a lot of the Asian countries, whether it's Taiwan, South Korea, Vietnam, for example, over the past 5 years, right, all these countries have much more increased trade surpluses against the US. So from that point of view, they are, very susceptible to tariffs. And when President Trump talks about reciprocal tariffs, the nominal numbers, from his point of view, clearly shows that, there is inequality. But we need to look down into more details in the structure of it. For example, the differential between agriculture imports in between US and India, right? India charges like 30-40% more. But there's a reason why, because India is an agricultural economy. They need to protect their own farmers and constituency. So it's not so straightforward. We are still a bit cautious and worried objectively about tariffs coming on the 2nd of April. And I guess we need to assess the depth and breadth when they do come along.
Okay, so you're concerned, you think there may be some complacency, but you rightly point out, of course, that there needs to be a focus on individual nations and their different trading relationships with the US. How does that tie into your positioning then? I mean, how risk off are you when it comes particularly to exposure to Asia?
So our view is that the dollar has been a little bit softer since the start of the year. So we still think the dollar may climb back up towards the middle of the year if risk aversion comes in, meaning our forecasts are still pricing a weaker renminbi, weaker Asian currencies, in view that the tariffs will start to materialize in the next months into the middle of the year. So we are still advising our customers and investors, if they can, to hedge their US dollar risk. After all, dollar has been the weakest over the past 2 months.
Does Beijing, talking of the renminbi, does Beijing have the toolkit it needs to offset the pressure of tariffs from this Trump administration? How does the fiscal firepower that Beijing has come into play in terms of compensating for that Trump tariff hit?
Absolutely. We think that Beijing, or PBOC for that matter, the central bank has a lot of levers to pull on this, and they have started to pull 2 key levers, right? The first is, of course, the focus on consumption in China. They have a 30-point strategy now to boost consumption from long-term structural issues like increasing birth rates, increasing local tourism, increasing minimum wage. So these are structural issues to boost consumption, right? Then, of course, that charm offensive from Beijing now this whole week at the Development Forum and next in Powell, where the authorities, your premier has been engaging foreign CEOs and the private industry captains. So this helps enforce that Beijing realized that you need ongoing innovation, ongoing private sector lead up for investment, for innovation. And all these things are trying to push for more consumption, more investment in China. And that, of course, is the unwritten approach to balance off the uncertainty when it comes to trade and the external sector.
Just briefly before we let you go, you have a conviction call on gold. Currently, the yellow metal above $3,000. What's the further upside? How much is priced in at this point, Heng?
So we have 3,002 forecast for the first quarter next year. Clearly, the direction is very strong. I think all of us know that there's a bullion physical shortage, all across the world because of the metal that's been shipped to COMEX in the US, and that is expected to continue. So it's a very clear, safe haven demand for gold towards 3,002.
Okay, 3,200 on the yellow metal. Thank you, Heng Koon, Executive Director and Head of Market Strategy at United Overseas Banks, also saying that the markets may be somewhat complacent when it comes to the Trump tariff risk. We appreciate your insights this morning. Coming up, over 1,000 people arrested in Turkish protests as President Erdogan takes steps to stabilise markets. More on the fallout following the arrest of his biggest rival. That is next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Tom Mackenzie in London. Turkish President Recep Tayyip Erdogan is pledging his commitment to the investor-friendly economic policies he embraced in 2023. Erdogan is blaming the opposition for market volatility spurred by the detention and subsequent arrest of his biggest rival, Istanbul's mayor, Ekrem İmamoğlu. Meanwhile, Turkey's interior minister says more than 1,100 people have been detained during protests across the nation. For more, Bloomberg's Deputy Bureau Chief in Turkey, Beryl Akman, joins us with the latest. Beryl, what has Erdogan been saying in terms of both the protests and his attempted support for the economy of Turkey?
In terms of the protests that have been going on since last week, President Erdogan's call has been that his government won't submit to any street terror and that he won't allow for the demonstrations that have been happening in defiance of government ban on any demonstrations and protests. He's also called the demonstrations evil in a recent speech. In terms of economy policies, in a televised speech following a cabinet meeting yesterday, he said that he would fully commit to the economy policies that have been implemented since his re-election in mid-2023. Those policies have been investor-friendly, and at the helm has been Treasury and Finance Minister Mehmet Şimşek, a former Wall Street banker and a well-reputable name among investors. Now, those policies have included raising rates from single digits to as high as 50 in about a year to tame an inflation crisis where prices soared over 75% in annual terms. That has eased a bit, but markets and investors were worried that the political fallout could have implications for the economy policy and could change the direction. And President Erdogan appeared to ease those concerns in his speech yesterday.
Yeah, and you mentioned, of course, the Turkey's finance minister, Mehmet Şimşek, with all of that experience that he brings to the table. He's been meeting with investors. How is he managing to bridge the tension between what critics of this government describe as a democratic backsliding and the need to support the markets and assure investors?
Finance Minister Şimşek has refrained from commenting on the demonstrations explicitly, but since Istanbul Mayor İmamoğlu's detention last week, he's taken to social media saying that there will be healthy market mechanisms achieved and that he's still at the top of his job, doing everything they can to manage the fallout. Bloomberg reported yesterday that he will hold a meeting with foreign investors today at 1 p.m. London time, and the main subject matter is the investor concerns that have been going on. While we have seen some pressure ease off Turkish assets this week, there's still an underlying concern related to political risk and heightened political tensions. And we've seen the central bank step in to defend the currency in the aftermath of that detention, raising a key lending rate, as well as managing excess liquidity in the market and ensuring that financial conditions stay tight. And the joint message that we're getting from policymakers with Şimşek at the helm is that they're in coordination and they will do anything to make sure that a repeat of last week doesn't happen.
OK, Beryl Akman, Bloomberg's Turkey Deputy Bureau Chief, on the measures and attempts by policymakers, of course, in Turkey to shore up these markets. The protests, anti-government protests, continue. Coming up, Russia and the US hold talks in Riyadh for 12 hours as the US pushes for that ceasefire with Ukraine. We bring you the details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Tom McKenzie in London. The US and Russian officials talk lasted about 12 hours in Saudi Arabia. That's as President Trump pushes for a ceasefire deal. Ukraine's President Volodymyr Zelensky says strong steps are needed to pressure Russia towards peace.
We need a movement towards real peace, towards guaranteed security. And we all need this. In Ukraine, in Europe, in America. Everyone in the world who wants peace in international relations. Russia is the only entity that is dragging out this war and mocking our people and the whole world. And to pressure Russia towards peace, strong things, strong steps are needed.
Meanwhile, the US president says the natural resources deal with Ukraine is, quote, just about completed. Tony Halpin, who leads Bloomberg's Russia economy and government coverage, joins us now. Tony, what are the expectations from these talks? US-Russia talks, they were 12 hours in length. Was anything achieved of significance to move this forward in terms of that ceasefire that President Trump has been pushing for?
Good morning. Yes, well, we're expecting a statement in the next few hours which will detail exactly what it is that they did agree. But both sides were saying that the main focus was on extending a ceasefire into the Black Sea area to ensure the security of navigation. And in principle, that ought to be a fairly easy thing for Russia to concede, because Ukraine has been fairly successful in pushing out Russia's navy from the Black Sea with drone attacks that have been going on for well over a year. So more interesting will be the detail and the extent of agreement on the existing truce on energy infrastructure, for example, how that might be monitored, how breaches of that truce deal may be spotted and punished, and whether or not they can agree to further extend the truce into other areas that would require verification and agreement.
Well, Tony, on that infrastructure truce, is it actually holding? We saw another barrage of attacks by Russia on Ukraine overnight. Is the focus and the carve out on energy infrastructure, is that holding?
Yes, and that's one of the issues of contention. I mean, Russia is interpreting this agreement very strictly as limiting itself to strikes against energy objects, power stations and electricity infrastructure and the like. And Ukraine was highlighting the fact that even as the talks were going on in Riyadh yesterday, a missile struck the northeastern city of Sumy and injured more than 90 people. So Ukraine has said very plainly that they're in favor of an unconditional ceasefire for this period of 30 days and not strictly limited to infrastructure. It's clear that Russia isn't ready to go that far yet, and the US doesn't appear willing to pressure Russia into making greater concessions on that.
And Tony, on the minerals deal, it's been on again, off again. Where does that stand?
Yes, both sides say they're close on that. The US clearly wants involvement in developing Ukraine's mineral resources. Ukraine wants to bind the US more closely into its economy as a security measure, if nothing else.
OK, Tony Halpin, who leads Bloomberg's Russia economy and government coverage, with the update there as we wait for more details from that conversation, of course, between the Russians and the US. And we're expecting a readout, some more details in the next half an hour, potentially an hour, and we'll break that for you when we get it, of course. Let's check in on the markets after a strong day on Wall Street. The mood has turned slightly in Asia, and you're seeing futures stateside pointing lower now by 0.1%. NASDAQ 100 futures. After that index rallied more than 2% yesterday, pointing lower just by 0.2%. Dow Jones futures also off by about 66 points. And here in Europe, European 50 futures pointing down by 0.2% after European stocks ended the session lower by 0.1% yesterday. Coming up, we're going to be back at the HSBC Global Investment Summit. Stay with us. This is Bloomberg. Welcome back. This is Horizons Middle East and Africa. Our top stories this morning. President Trump signals auto tariffs are days away while hinting at sweeteners in next week's reciprocal trade plan. Turkey's president pledges his commitment to investor-friendly economic policies. Meanwhile, the nation's Interior Ministry says more than 1,100 people have been detained during protests. And we are live at HSBC's Global Investment Summit in Hong Kong, where we are speaking to the bank's Hong Kong head of wealth and personal banking, Maggie Ng. We've also been speaking as well to the CEO of HSBC, and we'll play that interview for you in the next minute or so. It has just gone 5:30 a.m. here in London. Good morning. I'm Tom McKenzie. Welcome to Horizons Middle East and Africa. Checking your markets for you after a strong day on Wall Street, with the S&P ending up 1.8%, the Nasdaq closing higher by around 2.3%, Mag 7 getting a lift as well by the end of the close yesterday. Slightly different feeling right now, mood across the markets, seeing and giving given the strength of Wall Street overnight. You're actually seeing the MSCI Asia Pacific currently down, 0.1%. So some very modest losses across the Asian session after what have been a strong set of sessions over recent weeks for Asian stocks. European futures pointing lower by 0.2%. European stocks were off by about 0.1% by the close yesterday. S&P futures stateside now pointing lower by 0.1%, pointing lower by just 8 points. And the US 10-year having seen the yield jump around 9 basis points on the benchmark yesterday, currently yielding 4.32, largely unchanged. The Fed's Raphael Bostic telling Bloomberg he sees now just one additional cut from the Fed through this year. Let's check in on a terminal chart that illustrates how market participants are adjusting their views on the Trump tariff plan as we lead up to April the 2nd. And the betting market's suggesting that investors and money being put to work is and are expecting slightly lower odds now of big, impactful, large tariffs. We saw the reporting out over the weekend suggesting the tariffs will be more targeted. We've had commentary from President Trump just in the last 24 hours or so talking about potential carve-outs for some countries, but saying that auto tariffs could be coming in the next few days. So the uncertainty is still there as markets maybe start to reprice around what could be more targeted, ultimately more targeted tariffs come April the 2nd. We will, of course, have the details, and the reality will hit, of course, on that day. Now, back to one of the main interviews of the day. HSBC CEO George El-Hedary says he expects to double down on investment banking operations in Asia and the Middle East after exiting key businesses in Europe and the US. We spoke to him exclusively at the bank's Global Investment Summit in Hong Kong.
So what we announced is we will be incurring about $1.8 billion of cost, essentially severance cost.
Okay.
That the saving, most of the decisioning for that will take place this year. Most of it will take place in the first half of the year. That the benefits will start materializing this year, where the $300 million benefit will come this year. That the benefits will materialize in full by the end of full year 2026. So the full year 2027 will benefit from the full $1.5 billion saves that we're targeting. What we also committed that these will be permanent saves going forward, and that we're taking these saves straight to the bottom line. So it's a payback period of effectively roughly 2 years, but it's a permanent benefit that we will achieve.
And then the other component there is a further $1.5 billion, which I was looking at your earnings statement, and it was page 11 or 12, I think, of the strategic review. And the way you phrase it there is a reallocation of those costs into growth businesses. So I think it's a two-part question I have is, if you're reallocating costs, is that a net savings? Is $1.5 billion net savings? And what exactly are you looking at doing? Because there's not a lot of detail on that.
Yeah. So the organizational simplification benefits, which are efficiency saves, not impacting revenue in any material shape, $1.5 billion, those will be taken to the bottom line. That's the first $1.5 billion.
Yes.
Now, additionally to that, we're also looking at what we do and recognize that there are further focus that we can achieve in our business, where we will be taking $1.5 billion from activities that we are currently doing that are either non-strategic or non-returning, and we will reallocate these $1.5 billion as we materialize the saves. We reallocate them back into areas where we have competitive strength, where our customers expect us and need us to be, where we can generate good returns, and where we have greatest opportunities to grow. This second $1.5 billion, the revenue we will lose against it because we will be stopping activities.
Those units, those assets, yeah.
Those assets. We expect to be able to generate better quality revenue instead, because they're more strategic or higher returning.
And have you told your team, have you given a timeline for that second tranche of?
Yeah, we expect to do it in the medium term, but there are a number of these initiatives which we already communicated to the market. For instance, about $300 million of this $1.5 billion will be delivered through our decisions around investment banking, in particular M&A and ECM, in Europe and in Americas, where we're basically scaling down this activity. And others will come from other inorganic activities, such as the sale of our German private bank business, the sale of our French insurance business, Bahrain retail business, etc.
Looking at the timing of perhaps, and I know it's under review, so I'm not sure how much detail you could give at this point in time, but you mentioned a lot of those decisions will be made over the next few months. And correct me if I'm wrong, I think the timeline you gave was you want to complete the review by June of this year. When do you think you'll be able to make meaningful announcements?
So with regards the efficiency saves, most of the announcements are done. The rest is execution. We will be able to talk to how much we've decisioned. But again, we have committed to achieve these saves by the end of full year 2026. So we're working on that timeline.
Right.
With regard to the reallocation of costs from non-strategic or low-returning areas to strategic, areas of stronger competitive advantages and higher growth prospects, and obviously higher return prospects, we will announce as and when we have something to announce. So as I said, I've shared with you some of the ones that we've gone public with, and then the rest as and when we're ready to announce, we will make it public.
I mean, suffice to say then you're happy with your footprint, or if not looking to increase your footprint here?
Absolutely happy with our footprint.
What about investment banking in Asia Pacific?
Absolutely happy with our investment banking in Asia Pacific. Look, for the investment bank, we obviously want to double down on all our capability around debt. That's debt capital markets, leverage acquisition finance, and other financing activities, because that's the heart of everything we do globally. And in regards Asia and the Middle East, we want to also double down our capabilities in M&A and ECM. So the exit that we're processing now in Europe and the Americas is to allow us to focus at the areas where we can really be differentiating to our customers, where we play to our competitive strength, and where we really bring value.
HSBC CEO George El-Haroui speaking exclusively with Bloomberg's David Inglis. Let's go back out to Hong Kong right now, where anchor David Inglis joins us, having that conversation, of course, with the HSBC CEO, and now joining us with another fantastic guest, of course, from the HSBC Global Investment Summit. David.
Yeah, Tom, thank you for having me, of course, on the show, and yeah, thank you for making the space. I mean, we've had really good conversations here, and I think that was a perfect setup, the conversation we had with George there, because really, it's entering this new period, of course, for HSBC, and the pivot to markets where there's growth, the pivot to wealth, for example, the pivot to Hong Kong. Joining me here, in fact, is the perfect guest to talk about that. Maggie Ng, HSBC's Hong Kong head of wealth and personal banking. Thank you for taking the time. I know it's very, very busy for you guys. We just played for our viewers just now the strategic view and how things have changed and are changing. How does that affect you guys?
Thank you, David, for having me here. First of all, thank you for covering the GIS, the Global Investment Summit. This is the second year we're hosting it. We have more than 4,000 participants coming all the way from the world. And it just goes to show that Hong Kong is a super magnet connecting the world with our investors. So with the recent realignment, actually it has done two big things for us in Hong Kong and our wealth business. So firstly, by elevating Hong Kong and UK as our home market, it gives us a lot more autonomy. It makes things simpler for us to do things. So, for instance, in the last 6 months, I've opened 3 branches already. And this kind of speed has not been seen in the past in the old structure. With the new branch that we opened, for instance, just in West Kowloon, within the first week of branch opening, we have more than 1,000 appointments. The branch is fully booked all the way up to May. So this autonomy and simplicity allows us to get to market faster and serve our customer faster. The second thing is a lot more focus and anchor into the wealth investment and the Hong Kong business investment. So we've been benefiting from investment from group for years, and that's why in Hong Kong, HSBC, we have the largest RM coverage. We are the largest digital bank. We continue to invest into our digital capabilities. But with the recent alignment, we're even more focused into the wealth solution. So right now, we're getting investment, and our investment in Hong Kong is front to back. We're investing into RMs, network, as well as our operation and resilience.
Yeah, and I guess we could talk about your flows and new accounts in a moment, but since you mentioned it seems like an expansion phase as well, do I take it that you're looking to expand your headcount?
Yes. Well, we're looking to expand not only just headcount, but also our branches. So I've already opened 3 branches, and I'm going to have more branches opening up, and also into our digital capabilities. And that's because last year alone, despite we're already the biggest in Hong Kong and the largest wealth distributor operator. We acquired 800,000 new customers. And these are the customers, when you grow customers, everything grows. Deposit grows, lending grows, AUM grows. So we need to have more manpower, more infrastructure in order to support this growth.
Why not use technology then? Like AI, for example, to make things easier? You guys are, okay.
We have been embracing AI for years. For a couple of years ago, we've already used AI to train our large language model to improve our contact centers quality, fraud detections, improve our chatbot containment. And with the latest...
Is it customer facing?
No, this is more for staff monitoring and streamlining. With the AI, the new development in AI, we are now exploring ways for us to cover, using the new AI technologies to cover more of the research capabilities and also to train our RM such that, you know, we can provide more assisted tools for them to serve our customers.
Okay, new business, help us understand, decent year last year. Does the momentum continue? And, you know, connected to that as well, is mainland China still the major, let's put it, feeding market, of course, into Hong Kong?
Mainland China is super important for us in Hong Kong. Well, first of all, we have to understand Hong Kong is a wealth center. It's very attractive for international investors. And we, being the wealth center, we have a lot of solutions provided to investors coming from mainland China. HSBC, for instance, we have at least 800 fund choices for our customers alone, structured products, other asset management and ultra-high solutions. So any investors from mainland China come to Hong Kong will find something that they need to meet their investment objectives. And if you look at in the past momentum, the last year we've acquired quite a lot of customers from new to bank. 2/3 of them are coming from mainland. And with the favorable policies that we see between the two markets, we are continuously seeing more customer interest in Hong Kong.
And what's the 1/3? Where's the new business coming from?
We have also new business coming from domestic market. We are a Hong Kong bank. And also we have inflow coming from other international markets, including UK, Singapore, and South Asia.
Final question, what is one risk you're looking to manage this year as you try and deal with all this momentum coming through on the wealth side?
I think to make sure we stick to the core principle, which is to serve our customer with having the best outcome as the intent and also to grow responsibly.
Maggie, thank you so much for taking the time. I know you're busy, so we'll let you go for now. Maggie Ng there, of course, HSBC's Hong Kong Head of Wealth and Personal Banking. Tom, I'll send it back to you.
OK, David Inglis with those great conversations on the ground, of course, at the HSBC Global Investment Summit in Hong Kong. David, thank you. Coming up, switching focus, Ethiopia secures a deal with official creditors to restructure $8.4 billion of international debt. We bring you the details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Tom McKenzie in London. Ethiopia has reached a deal with its official creditors to restructure $8.4 billion of international debt, which will slash debt servicing by $2.5 billion through 2028. The move is a key milestone in the nation's efforts to overhaul its loans and boost growth. For more, Bloomberg's Ondira Ogunga joins us with the details. Ondira, walk through how this restructuring then plays into Ethiopia's efforts to overhaul its debt pile and finally and potentially boost growth.
Hi, Tom. So if we start with the second part of your question on growth and stability, one, it's going to release them from high debt distress, boost their FX reserves after the country suffered severe dollar shortages, and also unlock revenue that could go to critical sectors like agriculture, healthcare, and infrastructure. And it's important to remember that Ethiopia was one of the fastest rising economies in Africa, but 6 years ago, they endured drought, COVID-19, and then a 2-year civil war that has affected their growth. Now, if we touch on restructuring, getting this deal with with their international creditors is just the first step. The real legwork lies in convincing bondholders to come to a restructuring deal after they defaulted on a $1 billion Eurobond. And the ad hoc committee is arguing that IMF is underplaying the economic growth that Ethiopia is currently experiencing and the improved macroeconomic conditions. Ethiopia has had to do some reforms. They've secured an IMF program. So far, $1.5 billion has been released to them. And so this committee says that it's not a solvency issue, it's a liquidity issue, and they've rejected requests for debt relief. And they say that they're willing to sue to get the full amount. And we're seeing that the debt portfolio in Africa is changing. Initially, it was just OECD countries, but now you have bilateral lenders like China, who's the biggest lender to the African continent, also a sizable chunk of private bondholders, and that creates friction in trying to get restructuring deals.
Ondiro, to what extent is the story around Ethiopia a case study for other African nations looking to restructure their debt? What does it mean for other African nations at this point? Can they take lessons from Ethiopia? What is the outlook for the rest of this year?
So several African countries have taken this journey alongside Ethiopia. We saw Chad, they didn't get any debt relief. They only got an extension on its maturity. Zambia's process took way too long, and hence they couldn't secure an IMF program, which went to affect how government was running its functions in the country. Ghana was one of the lucky ones, completed its process in due time and was able to get relief of up to $12 billion. Currently, the country that can borrow lessons would say is Mozambique. They're not in debt distress, but they're very vulnerable. The economy was struggling even before their elections, but the elections and the violence that came with it exacerbated their risk. They've swapped their local currency debt, and they've given bondholders longer maturity, lower coupons, and so they can borrow a lesson or two from Ethiopia and learn that the debt restructuring process can be long and it can be painful. Yvonne Mhango, Africa economist at Bloomberg, says that the sub-Saharan debt is likely to peak following years of post-COVID fiscal consolidation, but in the medium term, we're likely to see debt to GDP begin to fall.
OK, Bloomberg's Ondiro Oganga in Kigali, Rwanda. Thank you very much indeed for the update, of course, and the story around the restructuring of debt for Ethiopia and what could mean, of course, for other nations on the continent looking to adjust the terms of their debt and boost growth. Coming up, a focus on the auto sector. We saw BYD outperforming in terms of sales in 2024 versus Tesla. We've had the latest numbers in terms of European sales, and Tesla's prospects in Europe continue to plummet. We bring you the details. That's coming up. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Tom McKenzie in London. Tesla sales have fallen in 10 of the last 12 months in Europe, with a 40% decline in February. Meanwhile, BYD sales surpassed the $100 billion mark last year, beating Tesla. Let's hear first from ARK Investment CEO Cathie Wood, who welcomes the competition between BYD and Tesla. She spoke to us exclusively at the HSBC Global Investment Summit in Hong Kong.
If you look at metrics like range and power for a given price, Tesla is still very competitive, if not the most competitive, depending on the model of car.
Right. There's nuance there.
Yes, but BYD is, from a cost point of view, moving down the consumer electronic battery cost curve, just like Tesla is. So actually, we think it's great. We think competition is great.
Bloomberg's transport reporter in Asia, Danny Lee, joining us now. Danny, against expectations then, we can talk about BYD. Maybe first, before we do that, we should talk about what's happening with the Tesla deliveries in Europe, where the drop just continues.
Yeah, as you said, 10 of the last 12 months where sales across Europe have fallen for Tesla, and particularly in February, the fact that sales fell 40%, and that's the second biggest when you look at the last 12 months. So really quite a beating there for Tesla. And again, against the backdrop of what we have seen in terms of the concerns around Elon Musk's involvement in politics, and especially what we've seen in the recent weeks, particularly around the European elections. So, yeah, whether there is a direct link or not between Musk's activities outside of autos and the sales, it remains to be seen. But clearly, what we are seeing is a precipitous drop in Tesla sales against also the backdrop of sales for EVs overall in Europe rising over 31%.
Yeah, and in Spain alone, around 60% in terms of the increase of electric vehicles in just that nation. Talk to us about the BYD-Tesla relationship then. Cathy Woods, some would say she's talking her own book. She's got that exposure to Tesla, of course. Where does that competition lie right now? Does the BYD lead over Tesla look further in terms of that expansion? Is that the trajectory we should be thinking about now?
That is broadly where people will be thinking when you look at how Tesla has kind of flatlined in terms of its innovation, when it still has a very narrow lineup of vehicles. And what we have seen, particularly in recent weeks, with BYD continuing to roll out new innovations, new products, and it really puts them at a new stratosphere of competition levels that rivals will have to try and catch up to, including Tesla. And so with BYD's results, its earnings that came out yesterday or Monday, it just shows how far it's come, particularly as it overtakes Tesla on revenue, and how much further it has to go, particularly as it's had a really strong start to 2025 and with more to come in the months and potential years ahead.
Danny, just briefly, we had news from South Korea and the Hyundai story around the investments in the US. Is that a kind of a trend that you're watching as well? Japanese, South Korean automakers looking to bolster their investments in the US?
Yeah, for the Japanese and the South Korean automakers, it's a real double-edged sword. They are trying to highlight the investments, multi-billion-dollar investments that it is putting into the US. But clearly they are heavily exposed, in fact, to this ongoing trade war narrative, particularly from Washington, as it looks to, with its neighbours, it's clashing with the likes of Mexico and Canada. So the real dynamic for these Japanese and South Korean automakers is pretty tough, because they are at risk from real punishment from this trade war if Donald Trump goes through ahead and really attacks autos and tariffs in its neighbouring countries.
OK, Bloomberg's transfer reporter in Asia, Danny Lee, thank you. And Trump saying those auto tariffs will be coming in, quote, in days. Here's the picture across the markets then. US futures pointing lower by around 0.1% after a strong session on Wall Street. European futures also off by 0.3%. Daybreak is up next. This is Bloomberg.